Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
So several listeners have asked me, why is it we release new episodes on Fridays? The answer is Louis Rukeyser. For those of you who do not know who he was, I will tell you. Louis Rukeyser was a financial journalist, columnist, and commentator through print, radio, and television. He was famous for his pun-filled humor and for trying to get investors to ignore the short-term gyrations and to think long-term. He was best known for his role as host of Wall Street Week with Louis Rukeyser, which began airing on PBS in 1972, and which Louis Rukeyser hosted for the following 32 years. And that show aired on Friday evenings. This is episode number 6 of Accredited Investor Markets Radio, and today is October 9th, 2014. Well, did you know that the average investor has 36% of her investment funds in cash? At least that's what Money Magazine's September issue says, with regard to a recent study by State Street. The study is discussed beginning on page 29 in a thoughtful article by Penelope Wang. Speaking of magazines, the September issue of Inc. magazine has its annual list of the 500 fastest-growing private companies in America. I don't know about you, but I devour that every year. It really gets me thinking about investment ideas. I don't mean just the specific companies that make the list. What those companies do can really be a clue to what trends are hot, what technologies are new, and more generally, what the future holds. I love it. So let's bring out our guest, Jesse Clem of Loquidity, LLC. Welcome, Jesse. And why don't you tell us briefly who you are and what Loquidity is?
Thank you, Chris, for the opportunity. I appreciate the chance to speak to your audience today. My name is Jesse Clem. I'm the CEO of Loquidity. Loquidity is an online real estate investment marketplace that we really focus on bringing exclusive returns to an accredited investor base, focusing on highly curated real estate deals, focusing in the central part of the Midwest United States. We're based in Grand Rapids, Michigan. My background really comes from the direct investment in real estate space and aggregation of capital. We saw a great opportunity with the passing of the Jobs Act late last year to build a curated marketplace that would bring deals that had normally been dark to many people, even accredited investors, bring these opportunities to them to invest to diversify their risk and asset portfolio.
All right. Well, let me ask you this initially. Why the regional emphasis at Loquidity? I don't know that every such platform has a regional emphasis like yours.
That is correct. We see a great opportunity in the Midwest. We're from the Midwest. The members of our team have spent most of their lives and careers in the mid-marketplace. And one of the things that we noticed of the other platforms, they tend to focus on the coasts, right? And the real estate markets on the coasts are different than they are in the Midwest. For example, the typical cap rates or return for cash and a real estate investment on the coast is typically in the 2 to 3% range, whereas cap rates in the Midwest tend to be in the 7 to 9 to 10 range. So there's a different type of real estate asset class that provides a different type of investment return. So we think there's an opportunity for those of us that know this space, know this area, know the investor base here, that are looking for steady cash flowing properties and assets, that we could use our network to really bring the best deals to this particular area.
Now, is that cap rate differential between this Midwest region and the coasts, has that been stable over the past 2 years or some other defined period of time?
Yeah, I really started direct investment myself personally in 2007. 2007, I think, I bought my first property after I had taken some returns from a company I had sold. And the cap rates I've really been in the 8, 9, 10 region during the course of the downturn in this area, if you found the right property, of course, at the right price. And they've been pretty steady in that area, pretty solid, strong, in the 7, 8, 9 range since the downturn.
Oh, that's very encouraging. Well, let us get a little more conceptual here and focus on how real estate investment opportunity and accredited investors have found each other. Of course, that's what Loquidity is about, at least in part. How they found each other, say, 10 years ago, and how they now find each other, opportunity and accredited investors. What's changed over the last 10 years or so?
Like many other aspects of investing, real estate investing or private placements in general is migrating online to benefit from an increasingly connected world, and in your case, your audience as well, Chris. What's different now than even 10 or 15 years ago is the incredible amount of free education and discussion about assets like real estate online today. So people become accustomed to doing all sorts of transactions online. I think what online brokerages did for investors in the 90s, investment crowdfunding will do for the investors in this decade with respect to private securities. So for example, technology online communities, they're enabling people to come together to support a cause, a business, a nonprofit, or in some cases come together around a historical building and a community, right?
Mm-hmm.
The Jobs Act itself has led to an increase in number of online investment platforms, both for both startups, in case you wanted to invest in companies, or real estate investing, which is where we're focused. So Loquidity is one platform that is using the new rules to allow sponsors to actually advertise their offerings on our platform, something that was banned for nearly 80 years. So that's a huge difference.
Well, Jesse, these advertisements online from the sponsors, do they take the form of a private placement memorandum, or are they something less lengthy, or what are they?
No, exactly, Chris. It still is a private placement memorandum, right? And we're subject to the 506C security regulations still, but we're allowed to generally solicit to certified and verified third-party accredited investors, right? So for our site, we require our investors to be verified through a third party that they are accredited, and then they will review a memorandum, private placement memorandum for investment in the opportunity that we're presenting.
All right. So let's stick with accredited investors now, and not the crowdfunding, although that's a very interesting set of issues. That presents a very interesting set of issues of their own. Let's look at REIT, Real Estate Investment Trusts, which I conceive of as the preferred vehicle for multiple party investment in real estate in the past. As a result of the Jobs Act, has access to REIT investment broadened?
REITs are different than crowdfunded investments for real estate, right? So traditionally, investors interested in real estate have had limited options from a direct investment standpoint, which is what my background is. Relying exclusively on networks of high net worth investors and publicly traded REITs was the options available for many years. But also, they usually come with high fees and very little transparency. So real estate crowdfunding actually gives investors, accredited investors, many of the best aspects of these approaches, including transparency and lower cost. So through a platform, investors can pick and choose in which property they actually want to invest, whether that's a debt or an equity investment. They can have significantly lower investment minimums to get in these private placements. For our offerings right now, our minimum is $5,000 per investment. And this allows them to diversify into many properties or many property classes, not just one particular property class. And then reputable platforms should have a proper due diligence process and not act like a bulletin board, and that's what we're doing. We're going to underwrite our sponsors as well as the investments very extensively to do the best curation of deals possible for our investor base. And investors no longer have to be a part of exclusive networks, right? This gives us the ability to share information freely.
So you're presenting an alternative, the direct investment alternative to the old networks and REITs, which makes me wonder, and I don't know that you're able to answer this, whether the REITs have upped their game by lowering their fees and increasing their transparency now that you guys are in competition with them.
That's a great question. I don't have an answer to that, but I think as any marketplace evolves, I think this form of capital aggregation is going to disrupt the real estate or any aggregation of capital marketplace in general, and I think REITs and institutional investments will look to leverage this type of financing at some point in the future. I think we're seeing places, but I haven't seen that specifically yet.
It's good to see disruption. Your firm then provides a digital marketplace, a platform for real estate investing, and it's both debt and equity investments, right?
It is.
So if somebody wants to buy a piece, they might get a chance to do that through your platform, or not just one chance, many chances. And if they want to invest in a form of lending, to use a term broadly, to a real estate project sponsor, they can do that as well. What different risks and returns are presented by equity investments and debt investments in real estate of this sort?
That's a great question, Chris, because every investment obviously has its own risks, right? And it really depends on the investor's risk profile and what their long-term investment goals are, right? If somebody wants a steady state annuity type stream, I say type in quotes there, type stream of income, maybe they would look towards more of a debt instrument. When I say that, like use the word lender. We would put together a deal that would issue a debt or a mortgage in the first position, or possibly mezzanine, which would be a second position loan. But we would vet that out, obviously. And if they were to invest in those positions, they would get a steady interest rate return, monthly or quarterly, based upon the terms of the loan. Typically, the loan duration we're trying to keep in the 6 to 12 to 18-month windows of time, so that a person will get that interest return steady, and then get their capital back in a short period of time as well. On the risk profile, we're trying to keep low, because we're trying to keep the debt ratio on the property or project pretty low to protect the investors, and obviously protect our returns.
To be number one in the event of a disaster.
Yeah, correct. Right, your capital stack position really matters there.
Yes.
To be specific, yes. And then from the equity perspective, you're looking more for a longer term type return. And in some instances, a deal we were just looking at, that looking to issue shares into an apartment complex that was performing very well already, but they had a plan to have it improve its performance even more. So in that particular deal, you would, as an investor, you would invest in it, and then you would have an equity position and not a debt position. So with all equity positions, they're secondary to debt positions in the capital stack, but you also have a chance for a return on the upside of the property as it appreciates, or we improve the performance of the property. And in some cases on those deals, we're offering preferred returns even to the investor, so that they would get their preferred return plus their capital back before the issuer would get any of the profits themselves. So we're trying to make it attractive and as secure as possible for the investors in some deals, but they're on a deal-by-deal basis, so each deal is different.
Awesome. Well, your website says that Loquidity curates top-tier offers for accredited investors, and you've used the word curate, in other words, functionally similar to that. So what goes into the curating? Can platforms be distinguished on the type or scope of curating of such deals?
A great question again, because curation is very important for us to protect our investors, as our investors are our lifeblood as a platform for sure. So, our team has decades of combined experience in real estate investing, especially in the Midwest. We have our own due diligence process and have our investors' interests in mind, as I've mentioned. It's amplified by the fact that we're among a few who put our own skin in the game on the deals that we bring to the table. And the deals that we don't bring to the table, we ask the sponsors to put some of their own skin in the game as well, so that the investors can see that everybody is interested and invested, and then they all are marching in the same direction with the same interests in mind.
But can I stop you there for a moment? Will the private placement memorandum reveal the skin that's been put in the game by the sponsor? It
will. Actually, if you went to our website today and looked at one of our deals that we actually just pulled out of, and I can explain why if you wish to go there, but we actually are through our due diligence, we actually stopped that deal. You'll actually see the equity breakdowns and the debt breakdowns of the deal and by whom, right? And not only just the sponsor, but any affiliated entities with them. So maybe the property manager, or maybe their attorney or their broker, whoever. We definitely break that out in the PPM as well as the marketing material.
Good, thanks. But I interrupted you. You were describing distinctions among curators.
Yeah, so our requisite expertise, one of the things that we would like to ask other platforms, and I'm sure they have their own answers to these as well, as I've been traveling around the country meeting with a lot of them, do the founding members actually have experience in these types of properties that they're offering? And in our case, we're only putting properties up there that we actually have experience in within our team or within our extended team. We try to do very conservative projections. It's better to err on our side of caution. We'd like to surprise people with better returns and great positions. Investors should carefully assess their risk profile, right, themselves, but we're doing our best job to put a conservative projection on each investment before somebody proceeds in the investment itself. We're really looking at quality over quantity. Since we've launched, we've had a huge amount of interest from a lot of opportunities I'll use, but a lot of them don't cut the mustard. And so you might not see a lot of activity on our platform. You go there the first time, you say, well, why aren't I seeing 20 opportunities there? Well, each opportunity is vetted very heavily. And if you go to the other platforms as well, you'll see the same thing. There's usually only a couple opportunities at a time. Therefore, they fill up pretty quickly. That's because everybody is making sure that we're doing this correctly. It's very important that we do that. When somebody looks at our website, they may come and say, where are all the deals? And the importance there is that, we're looking at quality deals. Since we've launched, we've had a huge pipeline of opportunities come our way, and not all of them cut the mustard for what we would like to see as a highly curated deal for our investors. And as the industry grows, more deals of varying quality, they'll appear online. If you look at our competing platforms out there as well, you're only seeing 1 or 2 deals at a time being offered, but they're being filled up pretty quickly because the focus from all of us is that we will make sure that we're bringing quality opportunities to the investor base. Investors should focus on those that we offer, being higher quality, but perhaps fewer deals at a time. Any platform that acts like a bulletin board may not have a substantive due diligence process, so be aware of that, right?
Yeah, okay, that makes intuitive sense. All right, so let's just look at the incentives of the sponsor who wants debt financing for their deal. All right, they're coming to the platform to get debt financing. They did not or could not get debt financing from a bank, or they're doing this in addition to getting it from a bank. How should the accredited investor understand a real estate sponsor's decision to issue debt through a platform?
I actually had this question from my mother-in-law the other day when she was asking me about this. So
they
it's not
usually,
only accredited investors that are asking the same thing, right?
They usually ask, mothers-in-laws usually ask the best questions. They cut to the chase.
They do cut to the chase, and sometimes you stand there, you're like, really? Okay. But I digress. So the question is a very valid one. So Loquidity intends to offer, investors, as we mentioned, both equity and debt, but other platforms may specialize in one or the other, or only offer commercial real estate assets or residential real estate assets. So each platform will vary here, but the reason why crowdfunding has exploded in popularity is in part due to the incredible contraction of credit during our Great Recession. Banks practically stopped making loans, as we know, consumer and smaller businesses, and investment real estate for sure. It's one of the problems I ran into as I was starting to grow my portfolio, was the investment real estate capital dried up, and from a bank perspective. And I started to go to people that had excess capital that wanted to lend, and some of those regulations haven't relaxed enough at the banking level still, and so there is a marketplace for investors who need capital to revitalize our communities and invest in our local economies, and there's a need for that, and we can provide that capital back to them in a very secure, safe fashion by debt positions, and offer a higher interest rate return to our investor base. And there are 3 reasons for that. The sponsors would still want to come to us besides the fact there are sources in the banks, but one of them is speed, right? Crowdfunding, once it's underwritten, we can raise capital pretty quickly, much faster than a bank can issue a loan. The underwriting process is just as extensive in some cases, if not more extensive, but the speed of actual funding is pretty quick. And then our competitive interest rates, but also on certain type, maybe a development or a bridge type opportunity, the interest rates are attractive to the sponsor, but also attractive to the investor base. We also have, from a sponsor's perspective, direct access to a network of accredited investors, such as those listening on this show today, right? They are a large, strong network that the sponsors may not have access to today, even though they have a great opportunity for investment, but their network may not be strong enough.
All right. Well, let's get a little bit more specific about something that I'm sure not that many people know about. Michigan has enacted a statute, the Michigan Invest Locally Act, in connection, presumably, with the Jobs Act, permitting general solicitation of accredited investors. What is the act? How does it affect an accredited investors' investment decision, and have other states been doing this?
Yeah, great question. So Michigan now joins a number of other states, including Kansas and Georgia and Wisconsin. I happen to know that Anthony Izzioli, who's the attorney in Illinois, is working on legislation to start the same process in Illinois. We're working with him as well to try to move that forward. But they're allowing businesses to receive crowdfunding from its own residents. It's called an intrastate crowdfunding. In simple terms, specifically the Michigan Invest Locally Exemption Act allows private Michigan businesses or entities to raise capital more easily from their own communities by exempting them, qualifying fundraisers from complex state security laws, right? So the big key here, though, is it's not just accredited investors. It can be a mix, unaccredited and accredited. And this really gets to true crowdfunding. So when we say the word crowdfunding, it kind of, when you say the word crowd, it's really, the crowd should be everybody. But when you go to the accredited investor pool, it's about 7% of the investing community. So there are people out there that want to leverage the full crowd for some investments, and there are people that want to leverage the accredited-only investor community. And then there are some acts like intrastate acts that allow you to mix both of them, but they come with increased regulations and scrutiny, obviously.
All right. Well, for a wind-up question, which really isn't a accredited investor question, although I think it affects all investors. So let us say a person invests wisely in real estate investments in the Midwest, perhaps real estate investments in the Midwest, which they found out about through Loquidity. So if an investor has a substantial amount of such investments, what sorts of other investments achieve a favorable diversification?
I completely agree with you. An investor should not be overexposed to real estate investment in a particular region, a particular asset class, or any one asset class in particular, and in our case, specifically real estate. However, the Midwest and Central U.S. have been overlooked by investors for some time. It just didn't have the panache the East and West Coast markets did, right?
We do lack panache out here in the Midwest.
But we lack it with pride, right?
Yes, excessive pride. Anyway, go on.
Excessive pride. This was actually a blessing in disguise during the recession, right? Our property values in the Midwest, in the Plain States and Mid-South didn't decline nearly as much as in other regions. Positive aspects about Michigan and the Midwest real estate markets are like increased manufacturing demand is growing right now. We're seeing a stronger auto industry and steadily decreasing unemployment rate across the area. I saw a report recently, and I forget the source, I apologize, but West Michigan specifically is said to be one of the largest growth markets for jobs in the country this year. Now again, it's starting from a smaller baseline, but it's starting to grow, so we're seeing strong demand for job growth in the territory again, which is a great thing for real estate. Industry diversification, right? The region's attracting a lot of startups and young talent. I know that cities like Ann Arbor and Nashville and Memphis and Columbus are getting a lot of startup activity, and Pittsburgh as well, and that's allowing the regions to grow. And then urbanization, especially in Chicago, Des Moines, and cities like that. People are moving back into the cities. Urbanization is a big, strong pull. And I believe Detroit actually is going to increase in population in the coming years with the investments that some local people like Dan Gilbert and his Rock Ventures groups and Bedrock Capital are doing down in that area.
All right, so great. There's a lot of real estate, but yes, ways to diversify.
Yep. Diversify now, right? So like any asset class, it's cyclical. Investors should spread out their risk between multiple regions, equity and debt and property types. We simply focus on what we know, primarily multifamily and commercial property in the Midwest. And then individual, though, can use this form to invest in real estate, but they can also do other asset classes too. We're not saying we should only invest here. Crowdfunding allows investors to pick and choose which properties they like, unlike REITs, right? Mm-hmm. In effect, they can create their own personal REIT if they wish, and they can even put some emotion behind it. We've seen people invest in only historic buildings around a particular cause they like. It's not necessarily always the wisest asset allocation mechanism, but this mechanism of aggregation of capital investing allows them to pick and choose what they wish to do.
Oh, I don't know. You were just putting me into mind of a popular song, Your Own Personal Jesus. This would be your own personal real estate portfolio. I'm just giving you the opportunity to put a jingle together for Loquidity.
I'll take that to the marketing department. I like it. Thank you.
You're welcome. You're welcome. We don't just take, we give here at Accredited Investor Markets.
That, right? It's a two-way relationship. I like it. We don't necessarily anticipate, investors converting all their cash into real estate holdings, right? But rather, as the equity and bond markets remain volatile, they're naturally going to look to diversify, and this is one of the ways to do that. And not only that, specifically to investors, I'm sure some of them have IRAs or self-directed IRAs. Many people don't know that you can take a self-directed IRA and invest in vehicles like this, real estate and businesses. I'm not a tax advisor or an attorney, I'll give that qualification, but there are vehicles like that allow you to invest and grow your returns tax-free as well as have the stability.
That's a good point, and one I think we'll pursue on a later episode of Accredited Investor Markets Radio, which is when you're choosing your self-directed IRA, should you choose one that allows you to invest in this asset class or that asset class through platforms and so on, it may be a very good opportunity to maximize one's return in the IRA.
For sure.
Well, I thank you, Mr. Jesse Clem, and you've been listening to Accredited Investor Markets Radio, a weekly podcast devoted to educating accredited investors about the basics of investing in alternative assets. We hope you tune in next time.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.